Hey guys, on this video, we're gonna discuss what is a cash-on-cash return as it pertains to real estate investing and why is it important. In this series of videos, we break down the essential terms and definitions that you must understand at least on a high level so that when you look at a real estate opportunity, you understand the jargon that is being used. And it's nothing more than jargon. Just like you understand what an MOD composite is and that it's simply jargon, this is the same thing with terms in real estate. They are jargon, industry-specific jargon, but that doesn't mean that it's difficult. On this series of videos, we're going to break it down in a simple way that you can understand it, and it'll empower you to make wise investment decisions. Remember, a knowledgeable investor is a wiser investor. The wiser the investor, the less chances of you losing money and the more chances of you making money. Now, before we get started, we'd love to hear from you. Are you enjoying the videos? If so, please smash the like button. And if you haven't done so already, make sure you hit subscribe and turn your notifications on so that you don't miss any of our upcoming videos. Hey guys, welcome back to the channel. I'm a successful endodontist with multiple practices, as well as a self-made multimillionaire in real estate investing. On this channel, we teach dentists and high-income professionals how they too can achieve financial freedom through passive investing. Now, what is a cash-on-cash return? Very simply put, on an annual basis, it's cash in versus cash out. All right, let's take an example here. Say we buy a commercial property for $1 million. From the operations of the property, from rent, from late fees, from application fees, from parking fees, from storage fees, all the income that comes in from the property, let's say that it's $130,000 of gross income comes in from this $1 million property. The expenses are $55,000. That's the expenses associated with operating the property. Lights, all the utilities, lights, gas, electric, property taxes, property management. All of the expenses involved with running the day-to-day of the property. When you take the gross income minus the expenses, you arrive at your net income or your net operating income. And in this example, $130,000 minus $75,000 will leave us with $55,000. We don't have any debt on this property because we bought it for cash. So we get to keep that entire $55,000 in our pocket. So what is the cash-on-cash return on this particular investment? You take the $55,000 of free cash that came from the property divided by our investment capital, which was $1 million. $55,000 divided by $1 million will give us a cash-on-cash return of 5.5%. So in this particular example, the cash-on-cash return of this property for that particular year is 5.5%. Now that's if there's no debt service. Majority of real estate investments, we don't buy cash. We always borrow money from the bank. Let's see what happens to the cash-on-cash returns in this example when we lever with debt. All right, guys, now let's look at an example with leverage or debt. Okay, so same example. It's still $1 million building, but this time we are only going to put down $250,000 instead of buying it for $1 million cash. This means less outlay of investment dollars. But that means that we need to borrow the other 75% from the bank, or $750,000 from the bank. We borrow it. Now the operations of the property won't change. It doesn't care whether you borrow money or not. The rent that will come in and the expenses will be the same. We still arrive at $130,000 of gross operating income minus a gross operating expenses will give us a net operating income of $55,000. The net operating income, again, from operations of the property. This hasn't changed. The NOI hasn't changed. But in this example, we're not putting this whole $55,000 in our pocket no more because we borrowed money. So the cost of borrowing money for the benefit of borrowing the $750,000 will cost us $36,000 a year in terms of mortgage payment. So $55,000 minus your mortgage payment of $36,000 will give us free cash of $19,000. That $19,000, ladies and gentlemen, is what you're going to put in your pocket. And remember what I told you, cash in versus cash out for cash-on-cash returns. So the cash out coming out of the property for that year is $19,000. $19,000 divided by our invested capital, which now is $250,000, because remember we borrowed 750,000. 19,000 divided by 250,000 will give us a cash on cash return of 8%. Couple of things to know from this example. Number one, notice that when we added leverage or debt service, we borrowed money, this levers the return. The cash on cash return actually goes up, and the overall returns from real estate goes up when you borrow money. That's called leverage, but we're not going to talk about that right now. That's actually covered in another video, and you can click on the link to get that video. Now, the other thing I want to tell you about cash on cash is, in this particular example, it's 8%. That means, in other words, you will receive 8% cash in your pocket from that year of investment. So if you invested $100,000 in this example, you should receive $8,000 in cash in your pocket for every year of that deal if the average cash on cash return is 8%. So if it's a 5-year deal and they tell you that the cash on cash return is going to average about 8% a year, that means you on a $100,000 investment, you should get $8,000 year 1, $8,000 year 2, $8,000 year 3, 4, and 5. So total cash should be about $40,000 over the course of 5 years. But again, cash on cash return, it only goes by annual. So 8% annually is $8,000 cash out from a $100,000 cash in. Now, the next question is, what is a good cash on cash return for an investment? Is it 4%? Is it 6%? Is it 8%? Is it 10? Is it higher? It depends on the deal. Say, for example, you invest in a developer. They're going to build a 100-unit building on this land site. They've already bought the land. They've got all the architectural drawings. They got approved for the city to build, and it's going to take 4 years to build. They need your investment dollars in order to borrow money from the bank and to get this project going. You invest your same $100,000 into this development deal. What is the cash on cash return during the first 4 years while they're building? The answer is 0. Why? There is no cash. There's nobody living there, and there's no income generated from the property because it's still just a piece of land. And it takes time to build these enormous structures. So a cash on cash return in that example is 0. Does it mean that it's a bad investment? No, but it is an investment that has higher risk because you're not getting any cash from the beginning. You have to wait for many years in order to get your returns. The longer you have to wait to get any money from an investment, the riskier that investment is, because anything can happen in that time. You could die, the person doing the deal could die, it could be a natural disaster, it could be a black swan event. So something that happens that completely upends and decreases the chance of getting returns. So the more cash on cash return that you can get earlier on in the investment, the lower the risk. So for us here at Walk of Wealth, for this exact reason is why we don't invest in development deals. Development deals have a chance for a much higher upside, and that's in exchange for a higher risk. We don't like risk, right? So we don't play along. We don't play in those arenas. We always invest for cash flow. Investing for cash flow is what allows you to have money for debt service and cover expenses. Cash flow is also, like, as I mentioned earlier, it helps you to decrease the overall risk profile for an investment. The other thing besides creating security and decreasing risk is that you also increase your velocity of money. So what that means is if you are getting cash flow back, so after 2 years, you've got $8,000 the first year, you got another $8,000 the second, you have $16,000. This $16,000 that you've received can now theoretically be reinvested into another investment which generates returns faster in a compounded way. So for that reason, it also, having a high cash on cash helps to increase the velocity of money and increase the velocity of your investments. And one final very important thing I want to add is we can't just look at cash on cash and this is the only metric you look at to determine if investment is good or not. This is only one of many that you have to be familiar with. So cash on cash will tell you about how much cash you should expect annually, but it does not tell you about the overall returns of an investment. Just because you're getting 8% cash on cash during the first few years, when there's a refinance or sale or major liquidity event of the property and you get a big chunk of cash, that's not reflected in your cash on cash return. So that's why you can't only look at cash on cash return when considering your overall return profile from a real estate investment. I hope that made sense. If it doesn't, please leave me some questions in the comments below. I'm more than happy to go into more detail with this. And if you don't have any more questions, I'll see you over here on the next video so we can continue this walk of wealth together. All right, guys, I'll see you next time. Johnny Walker.